Picture this. In the last 30 days, the precious metals market has looked less like a financial chart and more like a crime scene. Gold has dropped nearly 9%, while silver has managed to crash over 26%. At the exact same time, a major private credit fund managed by the largest asset manager on earth, I won't mention their name to keep the lawyers happy. Well, you know exactly who I mean well. They lost 19% of their value in just one quarter. These are not random fluctuations. These are the early tremors of a systemic fracture in a global machine that is effectively running on empty. The paper markets and the high-frequency algorithms are trying to convince you that silver is a relic of the past. Yet, the physical reality is telling a much darker story. While the digital price collapses, physical silver is disappearing from COMEX warehouses faster than a politician's promise. After an election, we are looking at just 103 million ounces left in registered vaults. This is the great disconnection. This is where the digital lie meets the physical truth. Listen very closely, because what I am about to disclose is not a prediction or a theory. It is an irreversible autopsy of the financial plumbing that is currently breaking behind the scenes. Before we dissect the hidden gears of this collapse, I want to see the reach of our observation network. Where are you watching this from? Whether you are in London, Frankfurt, or observing from the streets of Canada, drop your location in the comments. We need to map exactly where the real asset holders are standing, while the virtual world begins to shake, to understand why your silver is crashing on a screen, while disappearing in the real world. We have to look into the belly of the beast. We have to talk about the hidden gears of the financial machine, the mechanics of the digital lie. Most retail investors look at a red candle on a chart and panic. They think the world has decided silver is worthless. But insiders, we look at something called backwardation. In a normal, healthy market, a commodity should cost more in the future than it does today. You have to account for storage, insurance, and the time value of money. This is what the ivory tower academics call contango. But right now, the silver market is screaming in a state of backwardation. This is a technical term for a very simple, very desperate reality. People are so terrified of not having the physical metal that they are willing to pay a massive premium to get it right now, rather than waiting for a cheaper price in the future. It is the ultimate red alert. It means the trust in the delivery system has evaporated. When the cost of immediate delivery exceeds the future price, the system is telling you that the vaults are empty. But how do they keep the price down if the metal is so scarce? The answer lies in the leverage ratios. Imagine a casino where for every 1 physical ounce of silver in the vault, the house has sold 356 digital slips of paper claiming to represent that same ounce. This is not an exaggeration. At various points in recent months, the paper-to-physical ratio on the global exchanges has ballooned to over 300 to 1. It is a massive inverted pyramid resting on a tiny, singular point of real metal. This is where the Chicago Mercantile Exchange, the people who run the casino, steps in. When the price of silver starts to rise fast and threatens to expose the fact that the house does not have the metal, they move the goalposts. They call it raising the margin requirements. Think of it like this. You are a hedge fund manager playing with other people's money. You are using 20-to-1 leverage. That means for every $1 you actually have, you are betting $20 on silver. Suddenly, the exchange sends you a notification at 4 in the morning. They have raised the margin by just 2%. To a normal person, 2% sounds like nothing. But when you are leveraged 20-to-1, that 2% margin hike means you suddenly need 40% more cash in your account immediately. If you do not have that cash sitting under your mattress, the exchange's computers will automatically liquidate your position. They sell your silver at whatever price they can get, triggering a waterfall of selling. This is not a market crash. This is a forced liquidation. It is a controlled demolition of the price designed to protect the big banks, who are sitting on massive short positions. Speaking of the big banks, let's look at the footprints in the sand. We are talking about institutions like JP Morgan, HSBC, and Deutsche Bank. For years, these titans have been the heavyweights on the short side of the market, effectively suppressing the price to keep the illusion of the dollar's strength alive. But something has shifted. Our data shows that while they are using their high-frequency trading bots to smash the paper price down, their physical desks are doing the exact opposite. They are quietly, aggressively moving silver from the registered category metal available for sale into the eligible category metal held in private custody. They are essentially using the panic they created to buy back the physical metal at a discount from the very people they just liquidated. It is the Ultimate insider trade. They crash the paper market to trigger your fear. And while you are busy selling your silver coins to the local dealer in a panic, they are moving literal tons of bullion into private vaults where the public eye cannot see it. This is the hidden dance of the institutional elite. They know that a credit crisis is brewing in the shadows. They see the warnings from the International Monetary Fund about the $1 trillion private credit market. They see the massive exposure of commercial banks to failing office buildings and subprime auto loans. They know that when the next domino falls, the only thing that will matter is what you can hold in your hand. The largest asset managers on earth are not stupid. They are losing 19% in their private credit funds, so they are looking for an exit ramp. They are rotating out of the digital garbage and into the one thing that has no counterparty risk. They are moving into silver because they know that silver is the Achilles heel of the entire financial system. It is a smaller market than gold, easier to corner, and far more vital to the modern world. So when you see the price drop 26% in a month, do not ask why people are selling. Ask who is buying, because someone is on the other side of that trade, and they are not buying paper slips. They are taking delivery. They are locking the vaults, and they are waiting for the moment the music stops and the world realizes there are 356 people sitting in every chair. To understand where we are going, we have to understand where we have been. History does not repeat itself, but as the old saying goes, it rhymes with terrifying precision. If you think the current volatility is unprecedented, you have forgotten the lessons of the past. You have forgotten the names of the people who tried to break the system before, and you have forgotten the extreme measures the system took to break them back. Let us go back to the year 1980. The world was gripped by the Hunt brothers, two of the wealthiest men on the planet, who realized the same thing you are realizing now. The dollar was a melting ice cube, and silver was the only life raft. They began to corner the market, taking physical delivery of millions of ounces. They pushed the price from $5 all the way to nearly $50 an ounce. The establishment panicked. The exchanges changed the rules overnight, allowing only sell orders, and destroyed the Hunt brothers in a single day known as Silver Thursday. But fast forward to the year 2008. The collapse of Lehman Brothers revealed a banking system built on a foundation of sand. We saw the same tremors then that we see today, a sudden evaporation of trust, a scramble for liquidity, and a desperate flight into precious metals. Back then, silver was under $10 before it ignited a run that saw it touch nearly $50 again by the year 2011. But there is a fundamental difference between those past crises and the one unfolding right now. In 1980 and 2011, the game was being played primarily in the West. It was a struggle between Wall Street banks and Western speculators. Today, the board has expanded. We are no longer looking at a domestic squabble. We are witnessing a global divorce. We're looking at the great pivot from the West to the East. While the Western paper exchanges like the COMEX in New York and the London Bullion Market Association are busy playing their high-frequency trading games to suppress the price, the East is playing a much older, much deadlier game. They are playing for keeps. We are talking about the BRICS nations: Brazil, Russia, India, China, and South Africa. These countries have watched the West weaponize the dollar, and they have reached a consensus. They are done with the digital promises of the United States Treasury. Look at the data from the Shanghai Gold Exchange. For months, silver has been trading there at a premium of 10, 15, and sometimes 20% higher than the price in New York. Why? Because in the East, they do not care about the digital slips of paper. They want the metal. They are absorbing every ounce of physical silver that the Western banks are foolishly dumping onto the market to keep the price down. It is a massive one-way migration of wealth. The silver is moving from the vaults of the West, where it is treated like a speculative toy, to the vaults of the East, where it is treated like the foundation of a new monetary order. China in particular has become a black hole for silver. They are not just buying it for investment. They are hoarding it for survival. They understand that the power to control the future economy lies in the hands of those who control the physical building blocks. By draining the Western vaults, they are effectively disarming the dollar. They are waiting for the moment of maximum pain, the moment when a Western industrial giant needs silver for its production line and finds that the cupboard is bare. A hidden and profound redistribution of resources is taking place on a global scale. This is not merely a matter of price fluctuations, but a deep-seated rearrangement of global physical distribution and pricing logic. These shifts are often covert. For us, if we only fixate on the digits on the screen, It is challenging to discern where the massive flows of capital are truly moving within this multi-party chess match. Consequently, we have internally compiled a 100x silver profit map to help us clarify the underlying physical veins. I have shared this manual in the comments. Click to get your copy. This is the hidden war of the 21st century. It is not fought with missiles, at least not yet. It is fought with balance sheets and bullion. The West is obsessed with the price, while the East is obsessed with the inventory. In Washington and London, the policy is to print more digital currency to paper over the cracks. In Beijing and Moscow, the policy is to accumulate the only assets that cannot be printed, hacked, or canceled. Remember the year 1933? That was the year the United States government told its citizens that owning gold was a crime. They forced the population to turn in their wealth for $20.67 an ounce, then immediately devalued the dollar and raised the price of gold to $35. They stole the purchasing power of an entire generation to save a failing banking system. Today, they do not need an executive order to seize your wealth. They have something much more efficient. They have inflation. They have digital surveillance. And they have the ability to crash the paper price of your assets whenever you get too close to the truth. But they cannot stop the East from buying. They cannot stop the fact that the physical supply of silver is finite, while the supply of digital dollars is infinite. We are watching the end of a 500-year cycle of Western financial dominance. The pivot to the East is not a theory. It is a mathematical certainty reflected in the dwindling silver stocks in London and New York. The silver crash we just witnessed was the West's last-ditch effort to shake the weak hands out of the market before the true scarcity begins. They want you to sell your metal back to them so they can ship it east to settle their debts. The question you have to ask yourself is this: whose side are you on? Are you on the side of the digital illusionists who think they can print wealth out of thin air? Or are you on the side of the people who have spent the last 5,000 years proving that real wealth is something you can drop on your foot? The East has made its choice. They are betting on the weight of the metal. They are betting on the reality of the physical world. And as the vaults in the West continue to empty, the clock is ticking on the digital lie. While the suits on Wall Street treat silver like a ticker symbol that they can manipulate with a few keystrokes, the rest of the world treats it as something far more vital. It is the oxygen of the modern age. If you took silver out of the equation tomorrow, the 21st century would effectively grind to a halt. This is the industrial trap that the paper shorts have ignored, and it is the reason why this crash is the ultimate head fake. Unlike gold, which is mostly stored in vaults and worn as jewelry, silver is consumed. It is destroyed in the process of human progress. We are talking about a metal that is the most electrically conductive, the most thermally conductive, and the most light reflective element on the periodic table. There is no substitute. You cannot build a green revolution on hopes and dreams. You build it on silver. Look at the solar industry. We are currently witnessing a global explosion in photovoltaic capacity. Every single solar panel requires about 20 grams of silver paste to function. As the world pushes for carbon neutrality, the demand from this sector alone is projected to consume nearly 80% of the total global silver supply by the year 2050. In the last year, the solar industry consumed over 190 million ounces. That is nearly 20% of the entire annual mining production, and that number is growing every single day. But it does not stop at solar panels. Consider the electric vehicle revolution. A single internal combustion engine car uses about 15 to 28 grams of silver. An electric vehicle, it uses double that. We are talking about 50 grams of silver in every single car to manage the complex electrical systems, the battery management, and the autonomous sensors. Now, multiply that by the tens of millions of vehicles the global manufacturers are planning to pump out. The math simply does not work. The world is trying to build a high-tech future using a resource that is currently in a structural deficit. And then there is the elephant in the room: artificial intelligence. Every high-end server, every semiconductor, and every liquid-cooled data center that powers the models of the future relies on silver for its superior conductivity. As the world races to build out the infrastructure for artificial intelligence, the demand for silver is moving from a steady stream to a raging river. But where is the silver coming from? This is the evidence the mainstream media will not show you. Most silver is produced as a byproduct of mining for other metals like copper, lead, and zinc. This means you cannot just turn on a tap to get more silver. If the price of silver doubles, a copper mine is not going to suddenly produce more copper just to get to the silver. The supply is inelastic. We have had a global silver deficit for the last 3 years, meaning the world is consuming more silver than it is digging out of the ground. How have we survived? By draining the visible stocks, by emptying the vaults in London and New York. But as we discussed, those vaults are hitting critical levels. We are down to approximately 103 million ounces of registered silver at the Chicago Mercantile Exchange. At the current rate of industrial consumption, that is not a mountain of metal. It is a rounding error. This scarcity is already showing up at the front lines. If you walk into a local bullion dealer today, you will see the reality that the paper charts are trying to hide, while the spot price on your screen might say silver is cheap. The physical premium, the extra amount you pay to actually hold the coin, is reaching 40% or even 50% in some regions. Dealers are reporting empty shelves and wait times of weeks. For basic 1-ounce silver rounds, the bullion dealers are the real scene of the crime. They are seeing the panic buying from people who understand that a digital contract for silver is not the same thing as a silver bar in your safe. They are seeing the physical market break away from the digital illusion. When the industrial giants like Tesla or Samsung realize they cannot get the metal they need to keep their factories running, they will not go to a retail dealer. They will go directly to the source. They will bypass the exchanges entirely. When that happens, the paper market becomes irrelevant. The people holding the digital slips will find out that their contracts are settled in cash, not metal. They will get a check for a depreciating currency while the physical silver moves at a price that the world has never seen. We are talking about a scenario where industrial necessity collides with a finite supply. This is why the industrial demand is the ultimate floor for the silver price. You can manipulate a chart, but you cannot manipulate a chemical reaction. You can short a stock, but you cannot short the conductivity of a solar cell. The world needs the metal, and right now, the world is running out. We have dissected the mechanics, we have mapped the history, and we have looked at the cold reality of industrial necessity. Now we must face the most important question. What happens when the digital lie can no longer cover the physical truth? We are approaching a moment of total systemic recalibration. This is not about a simple price increase. It is about a transition into a new era of wealth preservation. Based on the forensic data we have analyzed, there are 3 primary scenarios that you need to prepare for. Scenario A is the liquidity trap. This is the most immediate risk. In this world, the paper price of silver and gold may continue to be suppressed by extreme high-frequency trading, but the physical premium will move to 100% or more. You might see a screen price of $20, but find it impossible to buy an ounce for less than $40. In this scenario, those who do not already hold the metal in their physical possession will be locked out of the market entirely. The gates will close, and the digital dollars in your bank account will be effectively useless for acquiring real assets. Scenario B is the currency lockdown. As the credit crisis we discussed continues to worsen, the central banks will move to protect themselves. This is where central bank digital currencies, or CBDCs, enter the frame. They will pitch it as a solution for stability, but it is a tool for total transparency. They will have the power to flag, tax, or even block transactions involving precious metals. If you try to sell your gold to a broker, the transaction could be instantly frozen for a compliance review. Your wealth will be yours, but it will be immobile. Scenario C is the hyperinflationary spike. This is the endgame that occurs when the industrial giants realize the vaults are empty. When Tesla, Samsung, and the global military contractors begin to bypass the exchanges and buy directly from the mines, the paper market will simply vanish. At that moment, the price of silver will not go up 10% or 20%. It will undergo a vertical revaluation. We are talking about gold reaching $10,000 and silver climbing toward the $150 as the world desperately tries to price a finite resource in an infinite currency. So, what is the strategy? First, understand that you cannot win a game that is rigged against you if you play by their rules. If you are trading silver on a screen with 20-to-1 leverage, you are not an investor. You are a target. The house will raise the margins and liquidate you whenever it suits them. Second, diversify your jurisdictions. If you hold substantial amounts of gold and silver, do not keep it all in one place. Consider private non-bank storage in mining-friendly and stable regions like Singapore or Switzerland. And if you are in the United States, look into the strategic advantages of a Roth IRA to protect your gains from the coming windfall profit taxes that the states will inevitably try to implement. Most importantly, you must stay informed with real data. not the noise of the mainstream media. They will tell you that everything is fine until the very second it is not. They will tell you that silver is a relic until they are scrambling to buy it themselves. The silver crash we just witnessed was a gift. It was a final opportunity to exchange a failing digital currency for a timeless physical asset at a controlled price. The door is still cracked open, but the hinges are creaking. Do not trust my words. Trust the weight of the metal in your hand. Stay safe. This rigid supply gap driven by high-tech sectors, combined with the reality of global vault inventories hitting critical alert levels, is leading to a structural imbalance that defies traditional volatility patterns. As the expansion of paper assets crashes into the physical limits of tangible production, the old benchmarks for measuring wealth may be undergoing a massive transformation. To address this, we have curated a 100x silver profit map to provide a clear logical coordinate system through the complex and shifting fog. This manual is available in the comments. Click to download.